The impact of coronavirus on the stock market is immense. It scares the stock markets. The Dow Jones Industrial Average (DJIA) lost 12% or more than 3,000 points in 5 days from February 24 to 28, the biggest 5-day decline since the Great Recession. The DJIA recorded the largest single-day decline, 1191, during that week, February 27. China is a key player in the corporate supply chain. That's why analysts are concerned that Chinese companies are not delivering spare parts to companies like Apple and Walmart, which would hurt their bottom line. Fear of the unknown causes panic. Stock markets hate uncertainty, and with this virus comes an abundance of uncertainty. When will there be a vaccine? How will countries contain it, and so on? The impact of the coronavirus on stock markets could continue. No one knows how long the impact of coronavirus on the stock market will last. But history shows us that stock markets overreact and then continue to rise. Today, the rapid spread of the virus increases fear, so people overreact. We need to take a break and not rush to the exit. Markets have quickly recovered from past viral epidemics. Will the impact of coronavirus on stock markets lead to a loss of capital for you? The change in the market, in itself, does nothing. You only lose funds when you sell below the market price. The results of some companies will suffer in the short to medium term due to insufficient inventories. Other companies will benefit. Although we do not know the severity of the virus, judging by past market reactions, caution is the key response. Are you a valuable investor with the target companies in your portfolio? Review your goals and stay the course, unless you see changes in the intrinsic value of the business. You speculated, you are looking to make money quickly with a margin account? If so, you will have a challenge because the banks will call your margin. This is the risk inherent in using a margin account to speculate. If you are not a speculator but a value investor, it may be time to identify value stocks and select them at bargain prices. There will be several. Whoever you are, be careful, reject the herd mentality and think about these questions. Stay the course. Review or develop an investment objective and plan before adjusting your portfolio. Why have you invested or would you like to invest? Your reason will determine your investment strategy. My preferred strategy is to buy top-notch stocks whose dividends have long increased. I hold these actions, I review their fundamentals from time to time and I act when there is a permanent change. You'll find valuable stocks today. Market fluctuations provide an excellent opportunity to buy strong companies with a good track record. Remember that you only lose, or win, when you sell, not when markets fluctuate. When the intrinsic value of your investments changes, confirm your strategy and sell your securities, even at a loss. Don't wait for the market to pick up. The market could be down for several years, like the Tokyo Stock Exchange, which has remained below its bubble level for more than 2 decades. Don't let generic asset combinations influence the distribution of your assets between stocks, bonds, cash and commodities. You are unique, and your combination should suit you at your stage of life. Think before you rush into assets of so-called refuge commodities, such as gold that has no intrinsic value. If you are in the red zone of retirement, that is, 5 to 7 years before retirement, your goal must be the preservation of capital, so avoid the stock market. Don't panic, focus on your goals, your plan, your long-term strategy. Update them and make sure they match your needs and risk profile. This too will pass, but only God knows the moment.